So in June of 2026, SpaceX just completed the largest IPO in history, raising 75 billion at an offer valuation of approximately 1.7 trillion dollars. By the end of the first trading day, it was up to 2 trillion, and then by July, it was slightly below its original price. Depending on when you're watching this, Anthropic and OpenAI are also getting ready to IPO. Maybe by the time you're watching it, they already have. And naturally, whenever this happens, there's a ton of YouTube videos and people saying, this is your chance to get in early on the next Amazon. This is your chance to buy. A lot of people saying it's a scam. It's valued too highly. So let's talk about what IPOs actually are and how they work, and hopefully provide some clarity around the topic. So an IPO is an initial public offering. It's the first time that a private company is going to offer shares to the general investing public through a registered offering. These shares are going to start trading on a public market like the New York Stock Exchange or NASDAQ, whereas before the IPO, the company is completely privately owned. It might be owned by its founders, employees, venture capital funds, private equity funds, and other early investors who had access when the company was worth a lot less, but that's not generally individual people just from the public. So before an IPO, you can't just open a brokerage account and buy those shares. There are ways that you can get access early on through other funds, obviously knowing the people in the company and other high risk bets, but for now, we'll just focus on the IPO itself. Now, the first thing is going to be the primary offering. So the company is going to create and sell new shares, and the money raised is going to go to the company, and it can be used to hire employees, build infrastructure, pay down debt, whatever. And then there's the secondary offering within the IPO. And this is where existing shareholders can sell what they own, and that money is going to go to them rather than the company. So, for example, when SpaceX IPO'd, there were janitors working at the company that were now millionaires on paper because the stock went up and they had stock compensation. Who knows if they sold or not, but they could have, and they would have been cash millionaires just by selling those shares that they already owned. A lot of IPOs are going to have mostly newly issued shares, so the primary offering, and then some are going to include both types of offerings. So an important thing to understand is, why would a company go public anyways? It's not to give ordinary investors an opportunity. They don't really care about you like that. They're doing it from the perspective of the needs of the company as well as the existing shareholders. So the first reason is going to be to raise money. They need money to operate their business. So obviously going public allows them enormous access to a lot of money, depending on whether or not people are interested in buying their shares. And then they can turn around and use that capital to expand, develop new products, build factories, and do whatever else that the business needs to do to grow. The other reason is to create liquidity. So founders, early employees, early investors, they have tied up significant wealth and time in the private shares that they own. Once an IPO happens, remember those secondary shares or that secondary offering, they can sell these shares and cash out, whether it's to take profit on their investment or they just need access to those funds. It's an opportunity to create liquidity for those people. And when it's a successful company, this is where a lot of that money is made. Those early investors, the day SpaceX went to the public, they've already made their money because they bet on it when it was hypothetically, let's say, $10 a share, and now it's trading at $165 a share. And that doesn't mean everyone cashes out immediately. There are even certain clauses within companies to prevent people from selling right away when something goes public, but those vary from a case-by-case basis. A lot of people, if they believe in the company, will continue to hold their shares and basically never sell. Now, these are a couple of common causes. There are many others, like creating visibility and credibility. Going public can increase a company's profile with customers, lenders, suppliers. It's more attractive when they can see this entity on the public markets. They know the numbers. You can attract employees and executives to your company. It's a pretty big deal to be a publicly traded company. Now, it's not all good things. There are problems with going public too. You have to disclose more information, publish regular financial reports. You have more shareholders to answer to, legal fees, accounting fees, dealing with market scrutiny, and all that stuff. So it is important to keep in mind that there's pros and cons just like anything else. So companies and bankers are generally going to choose to pursue an IPO when there's enough demand and hype and the market conditions are favorable for them to make a bunch of money. And that doesn't automatically mean that the stock is overpriced necessarily. It's hard to tell, but it does mean that the timing they did it at is based on what the company thought was best, not necessarily to provide you the best investing opportunity. So in terms of how it works, the first step, the company is going to hire investment banks, and you can call them the underwriters of the IPO. So this is stuff like Goldman Sachs, Morgan Stanley, JP Morgan, all those big names. And these banks are going to help the company prepare the offering, assess demand, market the shares, determine the price, and actually distribute the shares to the investors. And then they're going to file their documents. So in the US, the company is going to file a registration statement called Form S1 with the SEC, or the Securities and Exchange Commission. And this is going to be all the numbers, the financial statements, information about the business, details about the management, risk factors, how much the executives are getting paid, who the current shareholders are, everything top to bottom, what's going on in that company. And just because a company submits this doesn't mean they're going to IPO. They can delay it, they can change the offering, or they can even decide not to go public. This is just the initial step for the SEC to review everything and make sure everything's good to go. And then they get the show on the road. So management and the underwriters are going to pitch the company to potential investors. That might be things like pension funds, mutual funds, hedge funds, insurance companies. And they're going to see how much interest is out there. How many shares do investors want? What price are they interested at? How strong is that demand? Which investors are going to hold the stock? Which might immediately sell it? And this is basically called book building. And based on all that analysis, the company and the bankers are going to determine the final offer price and decide how the shares are going to be allocated. And then the next step is going to be that share allocation. So most shares in these large IPOs are generally going to go to institutional investors, high net worth clients, and brokerage customers that are kind of specifically selected by those brokerages, probably high flyers. And some retail investors, like the common person, might receive offer price allocations. So whatever your brokerage is, like Wealthsimple or Robinhood or whatever, they might run programs so you get some access to these IPOs, and it might give you a few shares that way. But it's usually a limited amount. You're usually not going to get the amount of shares that you place an order for. You're kind of the second thought after the big boys get theirs. And then the trading's going to start. So once a stock is listed, trading's going to start on the exchange. And now at this point, eligible accounts can buy it. So even if you didn't get the initial IPO offering, once it's listed, once the trading begins, now you can get in at whatever price it's trading at, which could be higher than the IPO price or lower depending on how it's trading and the market sentiment. So at this point, you're not getting the IPO, you're buying at the price determined by the buyers and sellers in the public market. So if the IPO was priced at $20 and the first trade happens at $30, the investors who got in on the IPO got in at 20, but whoever bought it at 30, that's the public market price. That's no longer the IPO price, and that difference is where a lot of money is made. Now, when trading does start on the public market, that first day pop or first day return is something that you're going to see in the headline. So if a company IPO'd, for example, at $20, and then the shares open in the public market or trading starts at $30, it might end the day, let's say, at $35, you're going to see media reports that the stock surged 75%. And that might be the case in certain contexts, but most ordinary investors that started investing after it went public, they didn't make 75%. That return was the people who received the initial IPO shares at the $20 price. And then the real money makers are the private investors that were holding on to that stock way before, when the company was much smaller and they invested in the seed round or whatever series round. Now, are IPOs actually any good? So there's a professor, Jay Ritter, at the University of Florida. He has the largest database of US IPO performance all the way from 1980 to 2024. There's like 9,000 of them. So he did the analysis, and based on the first day closing numbers, the average IPO produced a raw return of 19.1% over the following 3 years. And that doesn't sound bad, but when you compare it to the alternatives, you'll see something interesting. Over that same amount of time, those average IPOs underperformed the broad US stock market by 20.5% on average. And when he compared it to mature and stabilized companies in a similar area, IPOs underperformed by 8.9% on average. Now, that doesn't mean every IPO is going to underperform or that it's necessarily a bad thing to invest in them. But just like any other investment, this is why it's important to do your own research and see, do you actually believe in that company? Is it a long-term hold for you? Because there's a lot of competing incentives when an IPO happens. When you place a trade, your brokerage is making money no matter what. Those shareholders, they're raising money no matter what. Whether or not you make money is going to depend on whether that company is actually good and it goes up in price over time, or when you decide to sell or whatever. But the point is, don't just fall into the hype and do things because other people are doing them. There is a chance that you might find a really good company early on at a cheap price, but it's also a very real possibility that you're buying a heavily promoted business at a premium valuation where the real money's already been made and you're just buying the excitement. Now, there's another concept known as lockups. These are basically restrictions on shareholders. So a lot of founders, employees, those early executives, they have contractual lockup periods that are going to restrict them from selling shares immediately after the IPO. The exact amount of time can vary, but the traditional lockup is around 180 days. And once that expires, these early shareholders can then sell their shares. And if they do that, the amount of shares that enter the market can increase depending on how many people sell and how much they sell. So a lot of times you might notice several months after an IPO, the price might fall. And it's because these early shareholders, their lockup period's over. Now they can sell. There's more shares in the market. And as supply goes up, demand goes down. And that can trigger a lot of selling. So that's basically IPOs in a nutshell. And as always, the key take home point, like with any other investment, is to wait, be patient, and think about what you're doing rather than acting emotionally. A great business is not going to stop being a great business just because you waited a few months to invest in it. As we mentioned, there's a lot of hype, there's a lot of ulterior motives when it comes to IPOs. So be intelligent about it. Think, how does this company make money? What do its underlying numbers actually look like? Can I already get exposure to this company through ETFs and lower my risk profile? You can look at the prospectus, which is a tough read, but it's going to have the information that most people are going to skip over about the company. Don't just buy the story and the hype that other people are trying to sell you. A good rule of thumb if you're going to invest in an IPO is to think of it as speculation and keep the position small enough that even if it goes down 50, 60, 100%, it's not going to destroy your financial life. Don't gamble with it thinking that you've hit a jackpot, because again, a lot of these IPOs, the real money's made years ago with those private investors and those early investing rounds. And remember, if you're doing index fund investing, if this company's good and it keeps getting bigger, eventually it'll probably end up in one of the total market funds or an S&P 500 fund. And of course, you're not going to be getting as much gains once it's already there, but you still will have exposure to it. So don't let FOMO make your decisions for you. But that's pretty much it for IPOs. Hopefully that was helpful for you guys. Be sure to check out the newsletter and the community in the description. We're working on some resources there. Everything is free for now. So check that out. Let us know what you want to hear about next, and we'll see you next time. Cheers.